Tonight we have Lorenzo Codogno, who is currently visiting professor at LSE. So before he was at the LSE, he was chief economist at the Italian Treasury, which is how I got to know him, because I was myself the IMF mission chief for Italy between 2009 and 2011. And I had many trips to Rome to discuss the Italian economy with Lorenzo and others. And at the time, the Minister of Finance was Tremonti. And as the name suggests, he had a volcanic temper. And we had to spend most of our time trying to avoid an eruption, which I think I managed to do in my time there. But anyway, before the Italian Treasury, you were in the private sector.
Yes, Bank of America.
What?
Bank of America. Bank of America.
Bank of America.
Bank of America.
Bank of America. So you went from the private sector to the official sector, and now in academia.
Yeah.
And also you're a consultant as well.
Yeah.
Anyway, tonight you're going to talk about the Eurozone, which is a subject which we have chewed upon for several years now. But we're going to give us perhaps an Italian perspective on things. So I'll now hand over to you.
Okay, thanks a lot. Thank you, Adam. You didn't mention that at that time you were in the business of trying to have Italy into a program, and I was in the business of trying to avoid Italy into the program. But anyway, as you mentioned, I mean, I'm not an academic, so I have a kind of market economist background. And then at some point I was asked by the Italian Treasury to move there and to be chief economist. I didn't, meant to have such an interesting period, so to speak, but it didn't happen by design. But I went through the crisis effectively, which was a fascinating experience, although not an easy one. But it was really. Today, I'm not really talking about Italy, okay? I'm just taking a kind of European view, okay? But if you want to ask specific questions about Italy, I'm more than happy to answer that.
The usual arrangement is that the presentation is on the record, but then the Q&A afterwards is on Chatham House rules. So you can be, as frank as you like.
As I mentioned to you, I'm a free man now, so you can use whatever you like of my presentation. And so again, I will take a kind of European view, okay, drawing also my experience at European level, because during my 9 years at the Treasury, I was the Italian representative at the Economic Policy Committee, which is one of the junior committees of ECOFIN. And for 2 years, actually the difficult years, 2010, 2011, I was the chairman of the committee. And as chairman of the committee, I used to go to the EFC, which was the other committee, the programs are discussed, and to Eurogroup and ECOFIN meetings, so basically sitting around the table with ministers, which, as you can imagine, was a fascinating experience during the crisis, during the first Greek crisis. And so again, today I'll look at the crisis, try to figure out some kind of stylized facts, and trying to, think about the causes of the crisis, and also trying to draw some policy lessons. The way I'm going to do it is, first of all, I kind of give you a kind of overview of the whole presentation and some ideas. It only takes 5 slides, so that I'm sure that I give you the main messages, okay? And then, if we have time, I will go through all these other issues more in details. First of all, a bit more in details how the crisis unfolds, and basically looking at what I feel are the 4 legs of the crisis. Secondly, and touching a little bit more in details about the safety nets developed during the crisis. Third, look at the fiscal framework as it has developed during the crisis. Then look at the economic, the structural reforms and the economic developments in terms of macroeconomic imbalances. And finally, a little bit of the outlook for the future, what the 5 presidents' report might actually mean, what are the things that the report addresses, and the things that the report doesn't really address. But anyway, let me start with this kind of overview first. Why I'm saying that there are 4 legs of the crisis? Because the first leg of the crisis, I think it was really the contagion from the US. As you know, we got a collapse in the housing market in the US. At some point, the subprime crisis started in late 2007, and then there was contagion. Contagion basically through trade, and was quite severe, particularly for relatively open economies like Italy or Germany or Japan, okay, and through financial markets. The first contagion was quite severe. There was market turmoil, as you certainly remember. And the collapse in GDP, again, mainly in these countries, the countries that were exposed the most in terms of global trade, was quite sizable, quite significant. But then at some point there was some kind of V-shaped recovery. It was widespread. I would say Italy was performing pretty much in line with Germany in the recovery phase, and Japan. So it was really a huge shock with a V-shape, and at some point there was also the recovery. But at some point at the end of 2009, it became evident that Greece was cooking the books basically, and beginning of 2010 the situation became evident and became dramatic, in the sense that the European authorities had to intervene in order to address the issue, and financial markets started to effectively react. And in Europe, we started to have the government debt crisis, which was very much specific to Europe. It was not part of the global downturn triggered by the US, but it was really something specific to Europe. It was Greece first, then it became Portugal, Ireland, Spain, and eventually Italy. Italy, to me, is the third leg of the crisis. Why is that? Because it's a different ballgame. Let me say, okay. Up until, say, Spain, the problem could be managed in some way. Italy was too big. It was too big to fail and too big to be saved. So it was a kind of existential crisis for Europe, because there was no easy solution for Italy, and you know very well. He was ready to intervene from the IMF with some support, but certainly, it was no easy solution. I think you can agree that there was no easy solution. And the fourth leg is the second Greek crisis and the unknown, so to speak. So let's see what happens next. But let me also look at the crisis from a different angle. What were the different phenomena of the crisis? First of all, I think, as I just mentioned, it was an exogenous shock. The trigger was clearly the subprime crisis in the US, and was hitting Europe through trade and financial markets. But on top of that, we also got a macroeconomic imbalance crisis. It was typical. It was a typical emerging market crisis. So basically, sudden stop in flows from Northern Europe to Southern Europe, or periphery in general, and which basically caused the typical balance of payment crisis, as we have seen in the past in many other economies in the world. Certainly, the IMF is very expert in that field.
But within the Eurozone.
But within the Eurozone, yes. The key feature was that it was, kind of within the Eurozone. On top of that, we got the banking crisis, and it became evident pretty soon. First, because some banks in Europe were full of, so to speak, toxic assets. The assets that, collapsed in value following the subprime problems in the US. But then later on, we got what is called fragmentation. So basically, the banking sector in Europe imploding, interbank markets disappearing, and then there was effectively a renationalization of the banking sector throughout Europe. Then, on top of it, finally, we got also the public debt crisis, because following the banking crisis, eventually was you know, the cost of the banking crisis hit the public balance sheet because a number of countries were forced to intervene. First of all, Ireland, of course, but then other countries had to intervene in support of the banking sector. Even when countries had no need to intervene, which was the case of Italy, basically, because initially the support given by Italy to the banking sector was really pretty small. It was just extending some loan facility to one bank, basically, and a little bit more. And but even in countries like Italy, eventually there was you know, problems in the banking sector because of this fragmentation and this explosion in the interbank linkages across Europe. And that eventually became a government debt crisis for different reasons, again, because in some countries it was very much the banking sector problem that turned into public sector debt problems. In other countries, it was, you know, in Italy, the situation was already fragile, the debt to GDP was already high, so it didn't take that much to have a you know, a crisis. Then we enter into the difficult response to the crisis. You know, Europe struggled to find the solutions. I have to say that with hindsight, you know, if you think about the response, it was, you know, unprecedented. You know, it was, I mean, it changed completely the situation in Europe. But you can argue that was late and was not ideal. It was, you know, there were a number of different problems. So I think overall the response was a failure. Again, a failure in a sense that it came probably late. It was not done in an ideal fashion and so forth. We will discuss about that later on. But nevertheless, it was a huge effort. Finally, I think, and probably the most important point, and I will touch on that a bit more in details, it was above all a governance failure. A governance failure because Europe was not ready to respond to this crisis. So had to kind of figure out how to, you know, to develop rules, institutions, facilities and stuff like that. So it was basically a very difficult endeavor. So crisis of governance, just let me mention all the changes were introduced, a number of, you know, first of all the fiscal framework. Probably mistakenly, many attributed immediately the problems of in Europe to the high level of debt or the fiscal problems, which was certainly not the case. The fiscal problem came at the end, basically, of the crisis. Or as a result of the crisis. But the first reaction was really to tighten fiscal policy. And that was done with the fiscal compact, which revised the previous fiscal frameworks. And the timing, in my view, was not ideal because effectively the tightening fiscal policy happened in exactly the wrong time to some extent, because it was when probably you would have liked to see some kind of counter-cyclical policy, while say between 2011 and 2013 was purely pro-cyclical, basically amplified the downturn in a number of countries. Then you have revisions of Europe 2020, and let's say it's still under revision, the strategy for growth, and we haven't really seen major steps in the direction of a deep revision, but in the meantime, Europe introduced what is called the macroeconomic imbalance procedure, which is a way, I mean, let's put this way, the objective of this procedure wasn't clear, and is still not totally clear to me, but I think it was partly a way to spot future problems, okay, but more importantly, in my view, was a way to attach a formal procedure to the Europe 2020 process, or you know, before that the Lisbon process, which was about reforming, you know, different countries in Europe, introducing reforms. But in the past, this was driven by what is called open method of coordination, which was a kind of soft stuff. Okay, so you end up in Brussels, you discuss, you you have an open discussion, you learn from the experience of others, but at the end of the day, there was no binding commitment, no binding pressure on the country to do the reforms. So the macroeconomic imbalance procedure was a way to attach a binding procedure to the Europe 2020. And how it was done that? Well, basically, if you have reforms that are perceived to be very important for the sustainability, for the stability of the overall area, then these reforms become very important, and you have recommendations, and you have to respond to recommendations. Otherwise, you can actually be pushed into the procedure. That effectively the procedure was never triggered, or it hasn't yet been triggered. But a number of countries, including Italy, were very close, or they enter into a kind of area which is perceived a kind of limbo, okay, which was exactly before the triggering of the procedure, but not yet in the procedure. And if you are in such a limbo, you are under strict control, and it is called close monitoring. So basically meaning that you have to report every 3 months, and you have a strict monitoring, you have missions by, Commission, ECB and so forth, to see whether you are actually delivering on the reform process. We will discuss a little bit about that. I'm a bit critical. By the way, I was the chairman of the committee that developed macroeconomic imbalance procedure. Okay, so I take my blame but I'm not personally very much in favor of this procedure, and I will explain why. Because I think it took, an approach which is a little bit bizarre. But anyway, I will get into that. Crisis of governance means that there were no facilities also in Europe to respond and to finance countries. So European authorities had to become very creative, okay, finding ways to finance countries, first through bilateral loans, then through the EFSF, then eventually had to kind of develop a kind of permanent mechanism, ESM, in order to provide this facility. And I think one of the positive steps, a huge positive step, is the banking union, which is still an ongoing process, which at the moment is still surveillance a little bit more, but that was really a big step, I think, in the direction of integration. And finally, fiscal political union, which is still totally missing, at least as we speak today. So what's next with this in these areas? Macroeconomic imbalances, well, the adjustment is underway. Whether it is really permanent, it is sustainable, it's to be seen. I think that there is increased coordination at central level, and according to the 5 President report, we should have even more coordination and even more stringent procedures in the future. In the future, there will be also a drive to develop institutions. In the 5 President report, there is a proposal which has been also supported by the communication that was published not long ago by the Commission, to introduce competitiveness authorities in every country, which would actually be in charge of sending proposals and evaluating the situation in terms of structural reforms. Whether it is going to be effective or not, I don't know. But as you know, there is already a big process in each country, or at least in Italy. I'm familiar with that because I was the one in charge of the technical preparation of the national reform program, and that was a huge effort because you had to basically collect from all administrations, all inputs, all the things that have been done. It was a kind of effort throughout the year. Actually, it was not just a one-off exercise. I don't know whether adding another institution, which is, the Council, could actually improve the situation. In theory, this Council should be independent, okay, should provide independent advice to governments in order to introduce reforms. We will see. But certainly, according to the 5 President report, there will be a strong drive in the future to push for more reforms and more integration, economic integration among countries. But there is also an issue of legitimacy, which became huge with the Greek issue. If you have a government which is democratically elected in one country that doesn't really like the kind of policy recipes that they are, produced in Brussels, or that are consensus in Europe, but you might disagree with that. Legitimately, yes, because you are elected. Okay, it's a government that is elected. Then what you do? I mean, that's a big issue, because it's not like 1 + 1 = 2. When we talk about structural reforms, you might have different views. You might actually say, okay, we do things in a different way, but you can also challenge the fundamental hypothesis behind a reform. So I think this issue is still pretty much open. One way, I don't remember the exact term that is used in the 5 President report, but in my old days as chairman of EPC and later on as a delegate of EPC, the recent effort by the Commission to solve this issue was to develop some, say, common principles. So say you have a labor market reform, then you agree well in advance of the policy recommendation and so forth what should be the kind of the principles guiding a reform of the labor market. So ideally, this is the line taken also by the 5 President report. So because basically you should come up with a kind of shared view of what should be the direction. Okay, so if you do reform your market, the direction should actually go. But again, this doesn't really address the issue of, suppose that you have another Greek case with a legitimately elected government that totally disagree with the policy recipe. So what do? I don't know. It's still an open issue, but again, there is a strong drive now to move in that direction and make it more binding and more strict. Debt deleveraging is still a big issue in Europe, and despite the tightening of the fiscal framework and more stringent rules, the problem is still wide open. Because if you see, and I have a graph later on, if you see there has been a huge improvement in terms of reduction of deficits, but debt to GDP have increased almost everywhere, with the exception of Germany. And so they are at historical highs, and then you need to find a way to gradually reduce this debt to GDP ratios. Euro 2020, there was a kind of midterm review. There was an open consultation later in 2014, which collected a number of opinions by different governments, but also by private citizens, basically. And the Commission was due to publish a report, a kind of midterm review, in the spring of this year. But then, because of the new Greek case, and because of the 5 President report that was expected, the revision of the full strategy, basically that was postponed, and it was basically forgotten. So we're still waiting for that. Let me say that one missing dimension, in my view at least, is the single market. And there are a lot of issues in the Europe 2020. By the way, strictly speaking, the single market is not even included in the Europe 2020, which is bizarre, okay? And that is the big dimension that is still missing. And I think it would be probably an easy way to relaunch economic growth in Europe going forward. Then, on top of it, and this is pretty recent stuff, Capital Markets Union, which comes on top of the Banking Union. It's under discussion. The Commission has put on the table a proposal now how to review. It's certainly positive, but it's not very much ambitious at the moment. And one big theme that is now also in the 5 President report is how to move from rules to institutions in Europe. Because so far we have been dealing with rules, frameworks, and in the future more and more we have to develop institutions, not only to enforce the rules but also to govern the process. But more fundamentally, and this is the last slide of this kind of introduction, we are still debating what is the whole purpose of it. I mean, there are different views in different European capitals, because it's not clear at all what will be the end result. Even the 5 President report is, let's say, ambiguous, okay, on what is the final aim of all this. I mean, it mentioned political union and fiscal union, but, you know, as a kind of passing, citation, passing, statement. It was not really part of it. It's kind of something that will come in the future, but it's not really clearly defined. And it's not clear that this is really the aim, because even after 7 years into the crisis, if you talk to some policymakers in different areas in Europe, they would totally disagree. They would say, well, that's enough Europe. There's no appetite to move, to do more. Not only in this country, it's in many other countries in Europe. So I think I'm quite critical about the 5 Presidents report, not because it's not ambitious enough in the near term, which is also a problem in my view, but also because at the end of the day, if you have to propose something, you have to be bold. You have to say what you want at the end of the day. And there are people that might disagree with you, okay, but at least it's clear what you aim. And I think this is not clear in the 5 Presidents report. To be quite honest with you, the 4 President report, so the one that was prepared before, it was a bit bolder in actually defining what, but it was easily dismissed. It was basically put aside very quickly. The only achievement of the 4 President report is the banking union. And to be quite honest with you, it happened by accident. Okay? And why is that? Because there was the big Spanish problem, how to finance, how to support the Spanish banks. And there was a big debate whether, a European institution should actually bail in the Spanish banks, should actually support the bad bank, and so forth. Germany strongly opposed that, but at the end of the day, they had to give up something, and the something that they gave up was the banking union, so it was kind of a byproduct, if you wish, of the crisis, but it didn't happen by design. And this is, in my view, the only big achievement, following the 4 Presidents report. So let's hope that the 5 Presidents report will be a bit different, but so far I'm not particularly optimistic about that. And finally, in terms of initial statements, I think there is a model that has become obsolete. The modern Europe has always been that there is a small elite of people meeting in Brussels, that decide what is good or what is bad, a kind of enlightened elite, okay, which is good. I mean, I think this has been very positive in terms of driving the process and so forth, but it has shown all the limits now. So I think if we have to move in the direction of further integration in Europe, I think we have to move away from this kind of model. There is absolutely a need for more democratic legitimacy, and more transparency and democratic representation in the whole process. And is it going to happen? Yes, there is a clear section in the 5 Presidents report about this. The European Parliament will be given more and more powers in the future, but whether this will, really be driven by, more democratic, that's still to be seen. It's an open issue. Let me now go into the details. I won't probably be able to touch on all the points, but let me start with the 4 crises that I mentioned at the very beginning. Let me just highlight a few things that I think are interesting. Well, first of all, how the crisis started. It started well before the subprime crisis. It started actually with the collapse of the housing market in the US. As you can see here, it started in 2006, actually. In 2006, there was a collapse in the housing market, which eventually means in the summer of 2007 and September 2007 led to the subprime crisis. Following the contagion that I mentioned, so through trade and through financial markets, we got the big issues in the banks. Credit conditions deteriorated quite rapidly. You can see here the euro area and Italy, and you see that tightening credit conditions became immediate, became quite sizable, and GDP collapsed. We are say in the spring of 2009, and in the spring of 2009 the situation was in free fall in many countries, and the policy recipe is that you have to throw whatever you can, even the kitchen sinks if you have one, and to kind of stop the free fall. That was the policy recipe at that time. I'm saying this because that totally reversed just a few years later. Okay, so the problem during the crisis in terms of policy response was also consistency, because we changed from a neo-Keynesian approach to a kind of so there was no consistency of kind of policy recipe throughout the crisis. At that time, 2009, the real issue was to stop the free fall. So the policy recipe from the IMF to the OECD and so forth was, let's spend money. Okay, so let's forget for now the public deficits, and let's spend money, just prevent further collapse in GDP. And then totally reversed, the situation totally reversed. But probably at that time, it was not a very successful policy recipe. Why? Because probably central banks should have done a lot more immediately. I mean, the Fed did that quite a lot at the very beginning. As you can see here, it was the first to cut rates aggressively and to introduce QE. In Europe, it came much later than that. I mean, QE just was introduced at the beginning of this year, but even rate cuts, were not immediate, so to speak. Actually, if you look at 2008, the ECB at some point even increased rates, okay? And so it was not quick to react. While in that situation, in my personal view, the monetary policy reaction would have been the most effective. But should have been immediate and massive. Massive meaning you cut the interest rate to zero immediately, and then you do QE immediately, as was the case in the US, by the way. In Europe, unfortunately, for very specific political reasons and institutional reasons, the ECB was not able to do that immediately. And that was basically one factor that amplified the crisis. As I mentioned at the beginning, at some point after the first collapse in GDP, there was a kind of V-shaped recovery. So European economies were actually about to recover. Maybe not all the GDP lost in the first instance, but certainly it was quite severe. These are the OECD composite leading indicators, and you can see at that time they showed quite a nice rebound, actually, quite a V-shaped recovery in Europe. This is Italy, again, business confidence, industrial production, big jump, a big recovery. At that time, and this is taken by my presentation, so that time, the question mark was how much of the potential GDP was lost because of the sudden collapse in 2009. Well, the answer was, given what we have seen in the past, and that there must have been some kind of permanent loss in GDP, at least in terms of levels. Maybe not in terms of the rate of growth, but certainly in terms of levels. And this was the big debate at the OECD, also with the IMF. How much potential have you lost during the first leg of the crisis? But I still remember that when in Brussels with the Commission we did the aging report, and the aging report is kind of doing the long-term projections for pensions and pension spending and so forth. at some point it was introduced the lost decade scenario, okay, which was a scenario that basically implied a prolonged loss in terms of GDP, which was the worst case scenario at that time. And I can tell you, if we have to look back and look at that scenario, it was an optimistic scenario, because the loss in GDP that we went through during the crisis was much more severe than that scenario. So, we were not ready to acknowledge at that time that the situation could have deteriorated so rapidly. Then the second leg, as I mentioned at the beginning, Greece. Greece was downgraded by a number of rating agencies late 2009. Eventually, in May 2010, there was a need for a 3-year plan of assistance, which was quite big right at the beginning, so 110 billion, with the support of the IMF for 30 billion, and conditional upon an austerity plan, which with insight we could actually say that was probably not well designed. At least that was also the opinion of, it's now the opinion of the IMF, not at that time, but with the Greek crisis, government bond spreads started widening. In Italy, initially, was not the widening was contained, so it was not that severe, nothing dramatic. But in other countries, it was severe. So particularly in Ireland, in Portugal, and so forth. Then the Eurozone debt crisis started to unfold. We had the Irish crisis with a new package with the support of the IMF. Then we got Portugal in 2011, which was forced to ask for a formal program as well. And then we got Spain. Spain, it was mainly a banking crisis. In Italy, the situation started to deteriorate, and I can tell you exactly because I still remember very well the period, in July 2011. And it was a combination of domestic political bickering, if you wish, because there were a big debate about, do we do the pension reform? Yes, we do. No, we don't, and so forth. So, for a time there was this debate. Secondly, at some point, you probably remember the famous Deauville walk between Merkel and Sarkozy, and that was October 2010, if I remember correctly. But initially, the market took, the idea with a little bit of skepticism. So the market was not convinced that the so-called private sector involvement, effective restructuring of the debt, was really for real. Okay.
These are spreads.
This is the spread. As you can see, the big widening started in July 2011 here. And at the beginning of July 2011, it became clear that private sector involvement was for real. So basically that we were about to have some restructuring. And indeed, we had a restructuring. In late July, the Council decided to kind of restructure and the Greek debt. And that was, a shock for financial markets, because that was also one of the main reasons, at least in my view, that triggered further widening of spreads, because it became clear that no one is safe, okay, in the Eurozone, and that could happen also to other countries, and so that was one reason. The other reason, beginning of July 2011, was that we had a very bad non-farm payroll in the States, and then that changed the outlook, the global outlook for the economy. So basically, financial markets said, okay, there is a worsening of global conditions. Which are the countries that can actually suffer the most vulnerable? And Italy was among the most vulnerable. So if you combine some political bickering, the private sector involvement debate, which was very nasty and very negative in my view, and the shift in the outlook for global growth, there was a perfect mix for a widening of spreads. I have to say that also the policy response by the ECB was not ideal. As you remember, in 2011, the ECB started buying government bond paper. Initially it was Greece, then it became Portugal, Ireland, and so forth. And at some point started buying also Italian government bonds. It was, again, late July, August 2011, with the S&P. The S&P, the Security Market Program by the ECB, was a program that basically said, we are going to buy government bond paper with a limit and conditional to, you know, some reforms, some stuff. Now, if you say to market players that you're going to intervene, but it is conditional and it is limited, what's the message you give? It's like saying hurry while it lasts. Okay, it's like saying, well, you know, it's your opportunity to offload your positions, which was exactly what happened. Because in my view, that kind of program triggered the widening of spreads. It was very negative. It's like, I call it the kiss of death, because it's like, you know, the central bank. So again, the combination, at some point the spread widened. It became apparent that the crisis was really big. As you know, in late 2011 there was a shift in the Italian government. Monti came in with the kind of grand coalition supporting him and to do reforms, and for a while it was also effective. But in the meantime, because of widening of spreads and the fragmentation that became a huge problem in Europe, not just in Italy, the banking spreads started widening. So you can see the solid lines, the red and the blue. You see at some point there was a widening of spread, okay? And this is the banking spread for companies. So companies based in Italy and the same company based in Austria were facing totally different cost of borrowing because of the country where they are residents. The typical example was UniCredit at that time, because UniCredit had branches in different countries in Europe. And the same company getting money from the same bank, but based in two different countries, was the cost of borrowing was different, which effectively means that you no longer have a single currency, effectively, okay, if that is the case. And at that time, the banking sector suffered from a huge supply-side squeeze, and credit conditions deteriorated rapidly. As you can see, these are credit aggregates. There was a big drop first, then there was already underway a recovery, and then you had the second leg here. The credit aggregates collapsed and went into deep negative territory for a long while, and they are still actually in negative territory. Actually, the recent number was mildly positive, but the credit to the economy is still struggling to recover. Hasn't yet fully recovered.
And does that reflect reluctance to lend or reluctance to borrow?
That's a good question. My view is that at the beginning it was very much 100% supply side story. Basically, banks that had a big financing gap in the market had no choice but to cut lending aggressively, because the interbank lending was basically disappeared overnight. Okay, and they had no choice but to cut aggressively on the lending side. So it was a huge supply side squeeze of credit. Over time, it became a demand problem, because clearly the economy collapsed, so demand for credit collapsed as well. More recently, my view has become again a supply side problem because of the regulatory pressure. Banks have to, increase capital, and they have a limit actually. The IMF, beginning of 2015, in the Financial Stability Report, came out with a little study on the Eurozone, suggesting that with the capital that was available in the spring of this year, credit in Europe could only grow between 1% and 3%, because it was constrained by capital. So either you increase capital, okay, which is difficult right now because profitability is pretty low, and banks have already asked capital once or sometimes twice, in the market, or you have to offload the non-performing loans. That's why, for instance, the non-performing loan issue in Italy is so big right now, because, and it's not just Italy, it's also big in Spain, it's big in Portugal, needless to say in Greece, but also in Ireland, that has recovered a lot, but still has a lot of problems with non-performing loans. Now it's become again a supply side problem, because banks are somewhat constrained, because they no longer have enough capital to lend money to the economy.
So these are Eurozone figures?
These are Eurozone figures, yeah. Let me turn to Italy now. No, sorry. No, this. No. These are Italian data. Sorry.
Oh, that's Italian?
Yeah, Italian data.
Okay.
Yeah. No, if you look at the Eurozone picture, it's very similar to this one. Of course, there are big differences between the countries. Yeah. Let me focus a little bit on Italy now. This is a picture that shows a graph that shows the export performance. While for the whole economy we got a double dip recession, for exports it was just a single dip recession, because since the first dip, export activity has never stopped recovering effectively. Why is that? Because companies had no choice but to rely on foreign markets, and they were very aggressive. The euro supported also because it became weaker, and so they supported also export activity. But for exporting companies, it was just a single dip recovery, not a double dip, because the situation improved steadily. The unemployment picture deteriorated rapidly in Italy. You see, Italy moved from something below 6% in terms of unemployment, which effectively means 2% in northern Italy and double digit in southern Italy, and to something in excess of 13%. And now the situation is improving, but very gradually. This is a picture that shows you the recession in Italy. From peak to trough, it was minus 9.7 GDP growth. Okay, so a huge, a massive, unprecedented collapse in GDP, and it was particularly severe in terms of investment activity. You see the light gray line. It's in terms of levels is about 30% below the peak before the crisis. Okay, so a massive contraction in investment activity. Export, as I mentioned before, did very well after the first drop, and consumption, you see there has been an immediate drop in consumption. Then there has been some recovery actually. Basically, households, what they did was initially they started cutting a little bit on the expenditure, but then for a while they maintained their spending pattern by relying on savings. Okay, with the second leg of recovery, they gave up. So households at that time understood that there was no way to try to maintain the spending pattern. Yeah, on top of that, taxes, of course, and they started to cut aggressively the spending. So there was also a collapse in spending at some point. Now there is a recovery.
So would this imply that Italy is essentially running a large current account surplus now, or larger than it was?
Yes, I don't have a graph, but effectively Italy was, the current account deteriorated very gradually over the years throughout the past 10-15 years. With the crisis, the situation improved sharply because of the trend in export activity and so forth. Now Italy is in surplus territory, and sizable surplus territory, so about 2.5-3%, and mainly because of the difference between import and exports. And is it sustainable? I don't know, but I think there are good reasons to believe that it is rather sustainable. In other words, even if we see a recovery in domestic demand, probably Italy will stay in surplus territory. I think I will skip the safety nets, but let me touch on other things here. The fiscal framework as well, we have already touched a lot of things. Let me, two graphs here on fiscal framework. First of all, the deficit. You can see that since the crisis, because of the tightened fiscal framework, situation has improved. Countries have delivered fiscal consolidation, probably in a pro-cyclical manner. Okay, so basically amplified in many countries the recession, but the situation is improving. These are the main countries, but the situation is similar also for smaller countries. But the debt to GDP is very high, almost everywhere with the exception of Germany, where there is a steady decline. But let me move now to the Europe 2020 strategy and the reforms in Europe. The Europe 2020 strategy is a strategy that developed from the Lisbon strategy. The Lisbon strategy was about, again, introducing reforms. It was a strategy which was not binding enough, okay? And it was not particularly successful because it was basically up to countries to pick up, good ideas from other countries and in a kind of an open discussion with the others. But there was no binding force to allow for a change. Now, the Euro 2020 strategy was under review, as I mentioned. There was a communication by the Commission in March 2014 which said very clearly that there have been mixed progress in terms of the reforms, and you can also argue that the deep recession that Europe went through was to some extent also undermining the reform effort, because there was so much attention to the fiscal side and so much attention to trying to address the financing of the countries under stress that sometimes reforms went to kind of second. And up to now, I would say the reform effort in Europe, I think it was rather successful in Italy, to be quite honest with you, but and in some other countries in the periphery. But if you look at Germany and France, not much was delivered throughout the crisis. And so I think if you take a Eurozone overall, probably it's fair to say that the push for structural reform wasn't particularly successful at all. Well, I can go very quickly here, but well, you have to change the strategy. I think there's a need for a different approach, but I won't go into the details here. As I mentioned, the single area where there is a big potential, in my view, to enhance potential growth in Europe is the single market, and the single market is totally underdeveloped in Europe. Underdeveloped for products, but mainly for services. As you know, there was a service directive not long ago, and which was, pushing for major changes in Europe, but for a number of different reasons, situation is still far from ideal. The macroeconomic imbalance procedure, as I mentioned at the beginning, became the way to force countries to do reforms, because it is a formal procedure. Formal procedure means that you can get fines if you don't deliver. Has never happened, but again, a number of countries were very close to that point. Does it work? Well, as far as my experience goes, it has marked the shift, okay, because it is, again, a formal procedure. Ministers, when it is a formal procedure, they care. They look into it. When it is a formal procedure, there is discussion in Parliament, and needs to be clearly spelled out in a national reform program. So, at least in my experience, which might be very specific to Italy to some extent, but has become more effective, although not yet effective enough. I will go very quickly. The semester has become very effective. One of the big changes in Europe, oddly enough, is the semester. You might say the semester. It's a stupid thing, It's you just put together, procedure, and the semester was probably one of the biggest reform in Europe because basically forces all countries to behave in a certain way, to produce the reforms, the budgetary process, so forth, in a very structured way, so that you can discuss and you can force discussion in Brussels and push for things. So it was really a good one of the few good things that developed in Europe. I think I have to go very quickly here, otherwise. One attempt to strengthen the euro area together was the so-called Euro Plus Pact, which was an intergovernmental agreement of non-binding nature, which was introduced in March 2011 with a big fanfare, with a big, kind of publicity as stuff like that. But eventually, it was quickly forgotten. And now I think the attempt of the Five President report is to take the spirit of the Euro Plus Pact and actually amplify and strengthen the whole process. Which again, positive, it would be positive, but it won't be the game changer. 5 minutes.
You're a bit long for it. If you have a few more points you want to make, but I'm feel free to carry on.
Okay. So now let me get into the Five Presidents report. There are 4 fronts where the Five Presidents report wants to achieve results. One is the genuine economic union, which is really intended as a process to achieve economic integration. Effectively, this is perceived as a precondition to move further into any kind of integration. So countries should actually do reforms and approach and actually aim to achieve convergence in economic terms, which was perceived to be the missing point before the crisis. A financial union, which is composed of the banking union and the capital markets union. The banking union, as I said before, is probably the biggest achievement so far in terms of changes triggered by the crisis, but it's still incomplete. Why is that? Because we have a single surveillance in Europe now. The resolution mechanism is still not complete, although it should be completed pretty soon, because there are proposals on the table now, and there is already a compromise that they are discussing in Brussels. Hopefully, crossing fingers, it should come pretty soon. And then there is a third leg, which is the deposit insurance, which to me is going to be very, very tricky, because there are some countries that totally oppose that. My taking of the Five Presidents report, keep in mind that one of the 5 presidents is the president of the ECB, is decided, well, the 5 presidents said probably politically it's not the right time to push for a number of items. However, let's finish up at least what is ongoing, which is the banking union. So the banking union is the only process that, according to the 5 Presidents report, should be completed pretty soon, actually, because the Commission will put on the table at the beginning of next year a proposal for the deposit insurance, and hopefully, within a few months, there will be an agreement. Again, my personal view is that it's going to be very, very difficult, but at least let's give it a try, okay? And that will be the big piece missing for banking union. Once you have that, you can really say that it is a truly, a complete banking union. Again, it's a partial solution, certainly not what you would like to see in terms of integration in Europe, but at least it's another piece. So you have the single currency, you have the banking union. And the third piece is the capital market unions, which is the other part of the fiscal union. But let's face it, the commissioner in Brussels is an English guy, okay, which has no strong interest in pushing very hard, in my view, in achieving good results there. And the way we have seen proposals recently, and it looks like it's not about the single market. To me, the capital markets union is about the single market. So it's how to organize markets in a way that you achieve efficiency and so forth for the whole area. And there is a large part of the project which is related about financing the economy, which is, to me, is something different. It's not really capital market union. And on top of that, if you see the project, the first couple of years, it's all about harmonization, trying to fix some bits and pieces here and there, rules, changing the rules. They don't talk about institutions, okay? And as I said at the beginning, now the big move in Europe is moving from rules to institutions. Now, if you do something which is very ambitious, hugely ambitious, as capital market union, without institutions to take care of that, my feeling is that it's not going to be particularly successful. I mean, to be quite honest, the banking union has been successful so far because there is the ECB that takes care of all the technical details and deals with the process. It's a massive job. The capital markets union is a massive job as well, because it means changing the legal systems and without an institutions that really takes care of the issue, I'm not very optimistic about that. Then the Five President reports talks about the fiscal union, and for the first time it is explicitly mentioned a single treasury, okay, for the Eurozone, which I'm sure will be strongly opposed in many capitals in Europe, but at least there is a kind of objective. At least it is mentioned explicitly, but it is actually expected at the end of the process. So, and finally, there is only a kind of very small mention to political union, which should come at the end of the process. One of the key features is also strengthening economic cooperation and democratic legitimacy, and how you do that through risk sharing. I think the overall philosophy here is that you deliver in terms of economic convergence, and the idea is similar to the convergence phase before monetary union. So basically you have some parameters, you have to deliver on these parameters. If you are good, then you achieve more and more access to some kind of risk sharing mechanism. So it's the biggest change here is that you deliver reforms, you converge in economic terms. The more you converge, the more you have access to this kind of risk sharing mechanism. Whether this works remains to be seen. To me, if we look at the whole picture, it's more a stick than a carrot, okay? Why should be the other way around? You should show the carrot first, and then maybe you use some sticks. But I guess the approach is still more sticks than carrots. But we will see. But this is the philosophy. That's my understanding of the philosophy of the Five Presidents report. So, in the first phase, let's try to get convergence. Let me skip a few of this. So the three stages, probably you know about it. But anyway, I think it was driven mainly by political elections in Europe. As you know, you have in 2 years' time you have German elections, French elections, and you have the probably next year the UK referendum. So I think the idea was, let's finalize the banking union first and do some bits and pieces in the meantime. Then we move beyond these, political deadlines, and then we start with the second phase, which is the real stuff, which is where we can actually strengthen the union. And the second stage is the important one, which starts, however, only in the spring of 2017. So you might argue, well, can we afford to postpone everything another couple of years? Well, I leave it to you. It's a big question mark. But the more we wait, I think monetary union remains a kind of fragile construction. Let me skip these things. Okay. In the meantime, given that we have 2 years basically waiting for the second stage, at least in the meantime, let's try to do something. And the Five Presidents report introduced the idea of introducing competitiveness authorities at national level, plus strengthening the macroeconomic imbalance procedure, and greater focus on employment and social performance, and strengthen the European semester. Interesting things, certainly positive, but these are not, big changes for European integration. I go very quickly here. Let's let me go to a final point so that we can open the debate. Well, democratic accountability, I think, is a key issue, because the European Parliament has become more and more powerful and more assertive. So the European Parliament wants to basically have a say on everything, which is good to some extent, but it makes the whole process more complex. Now, I think the issue is how to make sure that European Parliament has a say on everything that is important, okay, in order to give democratic legitimacy, while at the same time making the process smooth. Because as you can imagine, negotiating the fiscal compact was a nightmare, because it had to be negotiated, the Council, the Commission, and the Parliament. It was really a nightmare and took many months to get. So I think from a practical point of view, it's certainly a challenge. There are other proposals. Make a single external representation for the euro. Very challenging again. I don't see German and French authorities giving up their role in international fora so easily, and so it will be indeed a very big challenge, but at least it's on the paper right now. Another big attempt here is to move from intergovernmental processes, and inevitably intergovernmental processes are complex and lengthy, into proper EU law. So there are a number of things that have been developed during the crisis, inevitably very quickly, and and that needs to be kind of consolidated into proper EU law, and eventually, of course, there will be a need for a treaty revision. Increased role for the Eurogroup. This de facto is already happening, has already happened, and probably in the future there will be also a full-fledged, full-time president and a dedicated secretariat, which would be certainly a good move. It might be problematic for the UK, of course, but it should be good for integration. Bottom line, and I end up here. Better rules or better institutions? Certainly there is a move towards better institutions in the Eurozone, with some exception. As I said, Capital Markets Union, oddly enough, there is no proposal for institutions here. Existing tools seems still somewhat insufficient to deliver integration, so need to strengthen the tools as well. More sticks than carrots, as I said. There is an approach which is learning by crisis, so to speak. In other words, we have to wait for another crisis in order to learn how to proceed again. Clearly, the priority in the first stage is for banking union, and which is good to some extent, because at least we deliver something which is real and is solid stuff. But everything else is a little bit forgotten. Ownership and solidarity. There's no reference to specific action here, but at least there is an attempt to go in that direction. For now, baby steps. There seems to be no appetite for immediate treaty changes, and European states are still perceived as sovereign national states. And I think people need to move away from that concept if really we want to strengthen integration. There is also very little reference to counter-cyclical policies. There is a chapter in the 5 Presidents' report, but I don't think it will be very ambitious. The whole five presidents report has been criticized for not being ambitious enough, but if you take the French-German proposal, then you change your mind, because then you think, well, yes, this is really very ambitious, because compared to the French-German proposal, it's nothing. Which means that there is really no appetite, at least in the two major countries, to move fast at this stage. Final point. Migration and security. Now we are under, this kind of big debate in Europe. My kind of idea, or if you want, very controversial statement, if you wish, is that to some extent this might actually change things a little bit, because it might actually increase the chance of what I call a big bargain in Europe. Because even Germany now has something to ask the other countries. And if we enter in a situation in which you have to give up on something in order to have something else, then there might be the conditions for a kind of great bargaining. Great bargaining means that, you can put together not only economic things such as, Europe 2020 or fiscal framework, so forth, but also non-economic stuff like security or military forces in Europe or migration and stuff like that, which to me might actually create the conditions and a more kind of fair bargaining, because every actor has something to give up and something to gain, and there might be a hope, if you wish, to achieve something quicker than what is in the five presidents report. But I would not bet on it, so to speak. I would not assign a very big probability for that, but it is a chance. And I'll stop here. Sorry about that.
Thank you, Lorenzo. Thank you.